early 2000s uncertainty, a contested election, all bets are off. Is that how you see things?
Yeah, that's right. So as long as we get an outcome, 50% of the country may not like it, but it's an outcome. And that's what we're hearing from a lot of our companies, too, that we talk to, is that they're just waiting for that to then start to get things going again. So we do need certainty there. And then obviously, our founding fathers were brilliant. So the House and the Senate also matter.
But it sounds like you think it won't be a contested election.
Yeah, that's right.
Yeah, why do you think that?
Because that's rare. I think that's what we're coming at.
Is it?
I think it is. So I don't want to be a political strategist here, Henry, but at the end of the day, it's very rare to have a contested election, and that's not what we're priced for. That's not what we're predicting. We think the election is going to come and go, and then one of the parts are going to win, and then I think that's where the November and December rally comes from, and that's what we saw in both 2016 as well as 2020.
If this is the U.S. market, can we talk about the rest of the world just briefly?
Sure.
Did the Fed just open the door for the rest of the world to ease a little bit more? I'm thinking of Europe.
Yeah, and I think he mentioned in the press conference yesterday that they've been patient, and I think the 50 yesterday was kind of a mulligan from the July meeting, and other central banks have moved. John, we're neutral that part of the world. If you look at the Morgan Stanley All Country World Index, excluding the U.S., that discount is like 37% to the U.S. Now, things can be cheap for a reason.
Gap or trap.
But we don't want to be too underweight that part of the world. So in emerging markets, that's about a 6% allocation. In developed non-U.S., that's about a 17% allocation. So you put those two things together, we still have about 23% of our 60-40 in non-U.S. We just want to be overweight the U.S. at this point.
Got it. Phil, thank you, sir. Long stocks in a big way. Phil Camporelli there of JP Morgan on the equity market and the bond market alike.
Interesting that it's not as overweight as it was earlier this year. And part of it is because I love the idea that you were talking about the closest shark. And what is the closest shark to the boat right now? Well, it is in 18 minutes, the initial jobless claims, and then it's earnings, and then it's the election, and that shark is kind of looming up, so we're going to have to talk about that shark until, people kind of get that out of their system.
It's Rick Reeder's line. I remember learning it from him a long time ago. We're always focused on the shark closest to the boat, and I would often say, what about the storm on the horizon, right? And you would be focusing on the storm on the horizon.
Yeah, but the horizon's very long for me, so there always are storms that you can focus on.
It's like tornadoes and lightning coming our way.
It's true. I have my own little cloud above me. But there is this issue where you do that and you lose, you miss out. And it's all the frustration that people have right now of seeing all those storm clouds, seeing all those storm clouds and sort of being paralyzed in cash. And then the storm clouds subside and it's rainbows.
JP Morgan comes out and says, get out of cash, we told you so.
Yeah, and it says, really? You missed the boat.
We've seen this a few times already, haven't we, in the last 24 hours. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. It was a volatile and still is pre-market session for Darden restaurants. They released earnings and initially shares sank by 4%, but turned around 8.4% higher now. The owner of Olive Garden posted comparable sales that missed estimates. The CFO pointed to softness in July that then improved afterwards. In a separate release, Darden and Uber announced a partnership for food delivery. Apple is facing an EU warning that will force it to open up its iPhone operating system. Sources say EU watchdogs are expected to announce that the company must step into line with new strict rules from its Digital Markets Act and make its operating system fully functional with other technologies. If Apple doesn't comply, the EU could launch a formal probe, which could lead to hefty fines. The 76ers are poised to remain in Philly after the city's mayor announced a deal for a new arena. Talks had been ramping up that the team could potentially move across the river to Camden, New Jersey, after Governor Phil Murphy offered steep tax incentives to develop there. Instead, the arena will be built in Center City and is backed by over $1 billion in private investments. The move, though, still needs final approval from the City Council. And that's your brief. John.
Danny, thank you. We can pause on that story. It's a piece of American sports that I don't fully appreciate. I just don't get. Aren't you just from the city and you stay in the city? Why do you move all the time?
Logistics. It's all about logistics. Because if you think about it, New York City football teams,
Jets and Giants,
all play in New Jersey. So go figure.
Yeah, for the World Cup, FIFA was touting that New York's going to host the final, but actually it's across the bridge.
I wonder how Governor Murphy feels about that.
Upper West Side.
Yeah. Up next on the program, the Morning Calls Plus. John Navarro of UBS previewing Lennar earnings as he expects increased home builder demand. That conversation up next.
priorities.
Could face bigger challenges. What's next?
Fed was going to keep rating while
This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Upper West Side. I like that.
Yeah.
Upper West Side.
Thinking about moving there?
Do you remember in London when they were trying to sell property in Battersea and it was South Chelsea? Do you remember that?
Yes, because I went to go look at an apartment and I was like, this isn't Chelsea.
You thought it was Chelsea, south
They
of the
got
river.
me.
Manus used to say, south of the river, dreams don't swim, or something like that. This is a very, very London joke.
Well, there was a very New York joke, a New York Times article about the 6th borough, Philadelphia, a while back, and it was quickly lambasted.
Who was more offended by that, the people of Philadelphia or the people of New York?
I think it was just
New York.
all around
Don't answer that
offensive.
question. Equities right now on the S&P 500, firmer by 1.6%. We're up on the small caps by close to 3 through most of this session. Let's get you some morning calls. First up, BTIG upgrading DoorDash to buy, highlighting the company's underappreciated growth potential. Your second call from JP Morgan, downgrading 5 below to underweight, saying recent channel checks point to softening sales. That stock is down 2%. And finally, Bank of America raising its price target on Toll Brothers to 165, expecting shares to benefit from the Fed's rate cut. Sticking with housing, Lennar reporting earnings after the closing bell, UBS reiterating its buy recommendation ahead of the results, expecting positive commentary on current demand trends and optimism given the moderation in mortgage rates. The analyst behind the call, John Lovallo, joins us now. John, it's good to see you.
Good to be here. Thanks for having me.
What does that rate cut do for this market?
I mean, I think, look, rates are down 90 basis points from when Lennar last reported earnings in mid-June. We know that demand has picked up. Toll Brothers reported in August that July was, this is their May through July quarter, that July was the strongest month with strength continuing into August. Other builders have said the same. Our private builder channel checks have been very bullish. Demand is better than seasonal averages at this point. Things are moving in the right direction. So I think that, that coupled with, think about new home sales in July, up 11% month over month to 739,000. Single-family starts yesterday, 992,000, up 16%. Activity is picking up, and that's a good thing. So I think demand is moving in the right direction.
Toll Brothers are for the fancy people. They don't need mortgages. That's all cash. Can we talk about who this really helps? Which builders does this really help?
I think it helps all. You're right. About 30% of Toll's buyers pay all cash. So you could argue perhaps a little bit less of a stimulus there. The lower end probably benefits the most. D.R. Horton, Lennar, companies that really focus on that, probably D.R. Horton the most, on that entry-level first time. Those buyers are going to have more dollars in their pocket. But keep in mind that the builders have been buying down mortgage rates all along. And so demand has been pretty good for the public builders all throughout this, this kind of interest rate volatility.
That's where I wanted to go.
Yeah.
I don't get this market. Basically, you have high rates, and that's good for home builders because nobody can move and no one wants to sell. So, if anyone actually wants to buy a home, you have to build it from scratch. Lower rates help them too because lower rates are better and people can borrow money. Which is it? At what point is it just price go up, period?
Lower rates are good for housing, Lisa, regardless. I mean, I think that that's kind of where we sit. Now, your point's well taken, though, right? I think the lock-in effect that has kept people from moving and reduced existing home turnover has helped the builders, no question about it. Now, lower rates are going to bring some more inventory back to the market, but keep in mind, 80% of mortgages are below 5%, 60% are below 4%, so there is still a lock-in effect.
There's this question about if lower rates unlock a great deal of supply from existing homes, but also from potentially home builders, won't that cause prices to potentially go down, not up, especially if mortgage rates are still well above the average that people are paying right now in their homes?
I think it would take an economic shock to bring back a glut of inventory. I think the inventory return is going to be more sort of, orderly, if you will, just given that lock-in effect that I talked about. Now, there will be more existing home inventory, but you know what? That also opens the pool of potential buyers. And so we think supply-demand from that standpoint will still remain, strong enough where prices are not going to drop dramatically.
John, oh, sorry. I was going to say, what do you make of all this being discussed on the campaign trail, potentially supply coming because of policy in Washington?
It's an interesting question. I think the Harris campaign's head is in the right spot, that we need more supply, we need more housing. The actual execution of that is very challenging because it can't be done at the federal level. It's really the municipal and state and local, kind of supply constraints in terms of land development, entitlement, zoning, permitting, things of that nature that just can't be controlled at the federal level. That's where the real problem is. And so, while it's a good idea, very hard to execute upon.
So some of these incentives you hear on the campaign trail, you just believe ultimately are going to lead to higher prices. Is that fair?
I mean, I think, putting more money in people's pockets, a $25,000 tax incentive, it will help demand. Could it push up prices a bit? Perhaps. I just don't see anything on the supply side really moving the needle.
At this point, what are you looking for in terms of taxes as well? We talk about the SALT tax and what that does to property buying in places in the Northeast. We saw people leave the Northeast in response to that. Do you get the sense that if that SALT tax cap was removed, that you'd actually get more buying in those regions?
Yes, I think that would certainly help. That said, the offset is that there's just an in-migration trend in the U.S. that's occurring because that's where job growth is happening. And think about the Sun Belt, right? That's where the employment growth is. The weather's a little bit better. Folks are moving in that direction anyway.
I like seasons, but go on.
So I think, yes, it would certainly help, but I think that the trend is still well ingrained.
So what's the #1 market right now to start building?
It's, I think, look, there's great markets in Florida. The Carolinas are very strong. Texas, most parts of Texas are very good. So really the traditional kind of, golden horseshoe states are still really positive. Now, it is market by market within each of those states, but I would say, generally speaking, that hasn't changed. Those are where you want to be, and that's where the public builders are.
Just to wrap things up, if I went to get a mortgage right now, 30-year fix, around 6%. Effective mortgage rate, so the average rate on the mortgages out there right now is just short of 4%. Still quite a big spread there of about 200 basis points. How much of a difference does 6 make to the unlocking, the lock-in effect that we've seen grip this housing market over the last few years?
I don't think it moves the needle all that much in the existing home side. It will help, for sure. But I think, what the builders have talked about is 5.5% kind of being the sweet spot of where they're buying rates down to. So there's no magic number, but I think that that's probably a fairly good indication of where you have to be.
Just quickly, for people who aren't familiar, when you say buying rates down to, what do you mean? What is that?
So the public builders are actually going out into the mortgage market, securing forward commitments to buy down mortgages at below mortgage average rates, which is allowing buyers to step into homes at much more affordable levels.
They've been working around this for the last couple of years.
They've been very successful, yeah.
I know. John, thank you, sir. It's good to see you.
Thanks for having me.
Appreciate it. John Navarro there over UBS on the latest in the housing market. Still a mystery. Do prices go up or down?
Yeah, well,
off the back of some of these moves?
It sounds like they're not going to move that much, and pretty much everyone does agree that you're not going to see some sort of dramatic price decline. So if you have missed out on the housing market, probably you're not going to get a much better entry point unless mortgage rates significantly fall. And I will just say my empirical evidence shows that 6% does not unlock.
If you happen to have a 3% mortgage.
She's rubbing it in now.
I know. Do you notice this with clients? Is this increasingly personal when you have these conversations?
I think it is, yeah.
Isn't it always?
Well, I mean, it's sort of like, what's in the water at JP Morgan. They can say, if you had gotten out of cash, you would have had this.
Should have listened to us.
Exactly. Although,
should have listened.
Honestly, it's fine. I'm okay with other people not having listened.
I'm sure you are. Up next on the program, breaking jobless claims, which I have to admit I'd totally forgotten about, taking place at 8:30 Eastern Time and dropping in about 4 minutes' time. We'll get the view of Mark Zandi of Moody's Analytics and Subhadra Japra of SocGen here to react. All of that on the other side. If you check out the price action, 1 hour and 5 minutes away from the opening bell here in New York City, equity futures up by 1.6% on the S&P. The outperformance on the Russell. The small caps are absolutely
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
We all have favorites. This is one of mine. Mark Dow, out on Twitter or X. The Fed's first hike was March 14th, 2022. Its first cut was yesterday. Over that period, the S&P 500 up 35%. If you fought the Fed, you won. Equity futures right now on the S&P 500 up by 1.6%. On a Russell, the small caps up by 2.6. Jobless claims data seconds away. The estimate 230. The previous week 230. The number, Mike McKee, a whole lot lower.
A whole lot lower. 219,000. So apparently Jay Powell is right. We don't have a jobs problem at the moment, at least. 219,000 compared with 231,000, which is a 1,000 up revision higher for last week. So a big drop this week. Continuing claims 1,829,000 compared to 1,843. So some big news there. The Philadelphia Fed Business Outlook Index comes in at 1.7 after negative 7.0. The employment index 10.7 compared with negative 5.7. So the jobs numbers coming in good in just about everything at this point. Prices paid in Philadelphia, though, goes up to 34 from 24. So if you want to worry about whether the Fed went too far too fast, that gives you a very tiny data point in which you can do that.
So if you're Torsten Slock at Apollo and you thought we didn't need to cut interest rates by 50 basis points because this economy is okay, if you thought that was a gift yesterday, you think it's a really big gift this morning. 219 on jobless claims is pretty impressive.
I went right to gold because Mike said if I want to worry about something, you can worry just on the margins about a little bit of inflationary pressure. And oh, look at that. Gold is at a new record high as it continues to climb on the day. This is sunshine and rainbows. This is basically everything you could possibly want. Things turning around, jobless claims going down. It raises a question. How high now is the bar for the Fed to move again by 50? Citigroup coming out saying they do expect another 50 basis point rate cut by the end of this year. How high is that bar?
So we'll get the view from Mark Zandi of Moody's in a moment, and I'd love his view on the labour market. And Mike, I'd love his view as well, and yours too, on whether jobless claims were a decent guide for Fed policy, because jobless claims have been okay. They went through 250, and that was right before that July jobs report, and people got a bit concerned. They've come back down to a 4-week average of 230 before this. We're down to 219 now for this print for jobless claims. Are they being led by what's happening here? Because it doesn't feel like it.
No, and we were talking during the break about the Beige Book and Jay Powell citing it yesterday. What you saw in there is kind of what's playing out. The companies aren't laying off people. They're holding on to people, but not hiring additional staff. And that's going to be the question is, at what point is the economy stimulated enough that you feel like you need to have more people in order to expand? Because at this point, everybody is just kind of happy with the status quo. And I assume that we probably aren't going to see a whole lot of movement until after the election.
What I find compelling is that Fed Chair Powell seemed to make a point of saying this isn't the pace of cuts going forward. And yet Bank of America and Citigroup both came out saying they do expect a 50 basis point cut at one of the meetings before the end of this year, basically showing that any further increase in the unemployment rate, even if for some demographic reasons, will not be treated with welcome, and any downside revisions also. Is that sort of the feeling that you're getting or hearing on the margins from Fed officials, or what the mood was in the room yesterday?
Well, you asked about where the bar is. The bar is now at 4.4%. That's what they're forecasting for the end of the year. So if we get to that level, they're going to think about it. If we go above that level, then you could see maybe a 50 basis point cut. But remember, now that we've gotten past this part, the Fed is bringing inflation back into it. They're going to be watching because now they've cut rates. Inflation did go up for pretty much all the indicators. We'll see what happens with PCE next week. But if inflation starts to tick up again, that would take 25, at least 25 out of that 50 calculation.
This is what the bulls have been screaming about, banging the table over the last few months. The economy's decent and the Fed's going to cut rates. In the last 24 hours, I think all that information is pointing in that direction. Right on cue, Brian Bowski over at BMO. New street high, S&P 500 price target, Lisa 6,100 on the S&P.
This is basically what Eddie Ardeni said would happen, that essentially you could see a lot of the gains brought forward. And why not? If you have a Fed that is supporting the view of markets while also seeing ongoing strength, well, that's the reason why back up the truck is the mood on the street today.
Jobless claims come in at 219. It's the right kind of downside surprise. The median estimate in our survey, 230. Joining us now to discuss is Mark Zandi of Moody's Analytics. Mark, looking forward to getting into this with you, so let's get to it. How strong is this jobs market still? Even with that rate cut, was it even needed?
Oh, yeah, no, it was needed. I mean, the job market's good, no doubt about it. We're creating a lot of jobs. Unemployment is very low. But all the trend lines were showing softness. I mean, hiring is off, hours worked are down, temp jobs are down. You know, the only thing that's really kept the job market together is those low layoffs, as you point out. The UI claim suggests that continues, so that's good news. But the trend lines here are still a bit disconcerting. So I think it makes every sense in the world for the Fed to start cutting interest rates. Now, I mean, more fundamentally, the Fed did what it needed to do. It got us back to full employment with inflation effectively at target. So if they've hit their mandate, then why a 5.5% funds rate target? I mean, I think everyone can agree. No, a lot of debate, reasonable debate about, what is the so-called neutral rate, that rate where policy is neither restraining or supporting growth, but it's not 5.5%. So time to get that down and get that normalized as fast as possible, because if you keep it there, something could break, and once something breaks, very difficult to get that back together.
And this is the reason why recalibrating, and recalibrated were the words of the day yesterday when we heard Jay Powell take the stand. A real question when you say concerning trend lines in the labor market. Do they fly in the face, those trends, of some of the enthusiasm that you're seeing in certain risk markets as people project this strength into the future, regardless of some of the clouds that maybe the Fed is responding to?
Well, the markets, investors are doing what they do. They forecast. They're forecasting, and they're saying, "Hey, look, before the Fed started cutting rates, before the Jackson Hole speech, and Jay Powell telling us that he was going to cut rates, it felt disconcerting, and the forecast wasn't quite as good as it is today. Today, forecast is much better. We've got a 50 basis point rate cut behind us, and clearly a string of rate cuts ahead of us. So you do the forecast, it feels like a soft landing. Therefore, I'm going to go buy stocks. I'm going to buy bonds. So, I think it's a rational response. I mean, at the end of the day, just think about this for a second. The economy is really fundamentally in a pretty good spot, and therefore the stock market should be in a pretty good spot. So it's not surprising we're at record highs and moving higher. So I think they're consistent. I don't think they're inconsistent.
The one note of concern, perhaps you could argue in markets right now, is this idea that maybe we are underpricing or under-considering inflation. When you take a look at gold prices, just hovering near those all-time highs, when you take a look at the long end of the yield curve, continuing to increase, particularly in the 30-year sector this morning, this idea that maybe we are going to see some uptick in inflation. Mark, are there signs to you, and I'm looking at housing in particular, as well as potentially other sectors, are there signs to you where you could start to see that inflation start to tick up?
No. Gold, Lisa? Gold, really? That's what you're pointing to? Come on. No. Inflation is back in the bottle. I mean, the thing that I think the most important to look at, inflation expectations. And there's lots of different ways of looking at that. You can look at the bond market and what the implied expectations are. Go look at the surveys that are being done by the New York Fed, the Conference Board. inflation expectations are all the way back in. So, as long as that remains the case, and I don't see a reason why that's going to change, I'm not worried about inflation. And housing, absolutely not. I don't think that's going to be the issue here going forward. I mean, if anything, in the next 12, 18 months, we should see further deceleration in the growth of the cost of housing services, because there's such a long lag between what's going on in the rental markets and when that actually shows up in the inflation measures. So the next 6, 12, 18 months, I think we're going to see, further deceleration. And in terms of setting monetary policy and interest rates, I think you shouldn't even be focused on particularly owner's equivalent rent. That's the posted cost of home ownership. Lots of good research coming out of the Fed saying that's probably something you shouldn't be focused on when trying to set policy, and I totally agree with that. So set that aside. You know what inflation is? CPI, core inflation, PCE, consumer expenditure related inflation. It's well below 2. It's kind of like 1.5 to 1.6, 1.7%. And it's been that way for more than a year. So that feels like, to me, the more salient measure of inflation. And that says not only are we at target, we could be beyond target. So no, I'm not worried about inflation.
Mark, inflation back in the bottle, as you say, mission accomplished, basically, is what Jerome Powell didn't say, but basically alluded to yesterday. The president's going to come out and speak tonight at the Economic Club in Washington, D.C. He can't say that. The real economy, people are not feeling the inflation that you're talking about.
Yeah. No, absolutely. I mean, people are still remember the run up in price back in second half of 2021, 22 into 23, particularly for staples, for groceries, for rents, for gasoline prices. And it's very hard to get by that psychologically. In fact, it's very interesting. You talk to folks and you say, how are you feeling about the economy? You say, not so good. You go, why? It's almost like everyone has this one food item that they buy on a regular basis that's the litmus test for everything. So I was talking to the social worker, my niece, the other day, and she's not feeling good about the economy. I go, why? She's paying a lot more for kombucha tea? I think it's called kombucha tea. So,
It's kombucha, but yeah.
Kombucha, sorry about that. I knew I got that wrong. Obviously, I don't drink it, but I was talking to a Wharton student. I teach a class in Wharton, and talking to this young man, and he's saying ramen noodle prices. So it's like everyone's got this thing, and I get it. And so you have to be sensitive to that. You can't deny that. But I think the way to respond to that is say, hey, look, I hear you, and these are the kinds of things that we're doing to address, to try to get the cost of living down for you. And I think that's what the president has to do, and that's what the candidates have to do.
Mark Sandy, thank you, sir, with an all-time clip that I'll be replaying repeatedly over the next several years. Lisa Gold, really? Really? Mark Sandy of Moody's. Mark, appreciate it, buddy. Thank you very much. Let's just take a beat and get to the price action going into the opening bell. Equity futures on the S&P 500 elevated. They have been all morning. We're up by 1.5%, call it 1.6 on the S&P. We've looked a lot at the Russell, the small caps, just backing away from session highs, believe it or not. If you are just joining us, welcome. We're up 2.5% on the Russell. It's the best of all worlds, right? The Fed's pulling back interest rates, and we've said it repeatedly on this program. When the Fed starts to cut interest rates, are they doing it for the right reasons? Inflation's coming down, growth still holding up, or the wrong reasons? Are they doing it because this economy is starting to crack? This in the last 24 hours feels like the right reasons. Claims reinforces that. I think a question a lot of people might have at the moment looking at stocks, can it get any better than it is right now? Is this the soft landing? Is it a moment in time? Can it get much better than this? Can it last?
Let's find out from FedEx after the bell, and then we'll find out from some of the other earnings. Really, it really puts more of a focus, more of a spotlight on earnings and how much companies are gaining efficiencies. Remember the AI story that dominated all of our conversations a couple months ago? Does that get sort of dragged out to send the indexes a bit higher? These are real questions, and honestly, it seems like the enthusiasm is defying people who are talking about valuations and saying, but what about the 493?
So that's the stock market, and that was Phil Camparelli at JP Morgan moments ago. This is the bond market. 10-year yields are higher. They're not lower. So you've got this breakout in stocks, but you don't see a similar move in bonds. If you were looking for rate cut nirvana and yields coming down on twos in a bigger way, that's not what you got yesterday. It's not what you're getting this morning. The 10-year yield is up by 5 basis points. The 30-year is up by 6. The following quote made me think of the next guest, This quote came from Capital Economics. Is the easing cycle already priced in? Markets barely reacted to the Fed's 50 basis point rate cut. On balance, our base case is that further cuts won't move the needle too much either. That was Capital Economics, and it made me think of Subhadra Chhabra of SocGen, who's raised this question a few times in her own research. Subhadra joins us now. Subhadra, good morning to you.
Good morning.
Has this bond market gone too far? Do you want to chase this? Have we seen the big move? Is the chunk of the move already behind us?
In the front end, it definitely seems that way because the market is pricing in nearly 200 basis points more of rate cuts by the end of next year. We're looking at, at least another 75 basis points of rate cuts by the end of this year. So it's very efficiently priced for a very aggressive policy path. If you have data that's as strong as it has been, it's going to be really hard for the Fed to justify a very aggressive rate-cutting cycle from here on. They're going to be very cautious. To us, another maybe 25 at the November meeting and a 25 at the December meeting type path, very much aligned with the summary of economic projections, makes sense. But a very aggressive policy path is what the market's pricing in. So that kind of caps, or I should say puts a floor on how much the front end can rally. And if you're going to get the stimulative effect of rate cuts, you're going to see that play out in the long end by way of higher yields and steeper curves.
So you're expecting high yields and steeper curves? Steeper curves led by the long end?
Yeah, that's very much the price action that we're expecting. The front end pegged, any sort of good news like we got today with the claims is going to play out as higher yields in the long end. So the steepener curve steepening trade is very much here to stay. So it's going to be a question of how much more that's going to be the trade led by the very front end rallying. And that's really where I think it's very difficult. Unless you see a meaningful deterioration in the data and the Fed has to deliver what's priced in, it's going to be very hard for the front end to rally meaningfully from here.
I'm looking right now at the yield curve, the gap between 10-year and 2-year yields, and you can see it's the highest level going back to when it last was positive in the summer of 2022. I wonder what this means for credit. We're talking about how you do get a boost in equities in the heels of this because the soft landing nirvana can continue. Do you lean in given how tight spreads already are?
It makes it very difficult to over-allocate to credit at the current time, given the fact that spreads are extraordinarily tight. So you have to kind of pick your spots, I would think, in credit as well as in some of the risky assets, given how much the markets have performed. But broadly speaking, if the Fed is ready to cut rates and ease policy, that's positive for some of these assets. And if you're looking at yields and total returns, you're still getting pretty decent yield in being in some of these risky assets.
The reason why I ask is because Phil Camporelli came on and basically, in so many words, said, I told you to get out of cash, buy some income. If you missed it, sorry, it sucks for you, but you can actually get a little bit more. Do you feel the same sentiment from your clients? And do you feel, albeit at sort of less attractive valuations, do you feel like it still is an okay time to extend and lock in some of the yields that we're seeing?
So I don't. I think that the front end is going to continue to offer a lot of value for investors to park their cash in because, the yields are quite attractive. And the front end is going to be much more sort of reactive to policy and Fed rate cuts. So you're going to get a pretty decent yield by having your money still in the very front end. And then when you have this dynamic of the long end yields starting to rise as the Fed starts to cut rates or ease policy, you are going to have other maybe time later for you to enter into the very long end. So to me, I think that money market funds still look quite attractive. You might want to pick your spots in the risky asset spectrum.
Sticky. That's why I hear there. Not what we heard earlier this morning at all.
Which is the reason why it's gone from $5 trillion to $6.3 trillion in terms of the assets in money markets and why maybe some of that cash isn't heading out so quickly.
So, Badger, you alluded to this. Can you just breathe some life into 2025 just a little bit more? You said 225 basis point cuts for this year into year end. That's the view over at SocGen. How big is the gap between you and market pricing right now for 2025? How much daylight is there?
We still think that the market is overpricing cuts for next year. So
what? Are we talking like 50 basis points? What are we talking about?
Probably not by a lot. I mean, 50, maybe 75 basis points. So I think the Fed's going to be very, very cautious. So at least my read on the press conference was that Powell kind of thought that the dots might be the floor for where they're thinking policy can go. So if you take that sort of view, then they're going to be very cautious and not cut too fast too soon. They came into the meeting thinking that they want to move away from restrictive policy and to front load some of those cuts. But from here on, they're going to be very deliberate and data dependent. And the data is going to really need to justify cuts from here on.
Data dependent for 2025 or policy dependent?
I think it's going to be data dependent. By policy dependent, you mean?
We don't know what's going to happen in Washington, yes.
Yes, I mean, fiscal policy is definitely going to be something that we're going to be paying very close attention to. If we do see the trajectory for debt and deficit start to rise because of policies from either of the candidates, first of all, we don't have much clarity on how things are going to play out for 2025 because these policies are being discussed as we go along, even though we're this close to the elections. So fiscal policy is definitely going to be something that's going to be driving long-end yields. So that's something that we're going to be paying attention to. There are implications for inflation. So again, that's something that the Fed's going to be paying attention to while they're thinking about easing policy next year.
November 7th appearance in the last 24 hours. We'll have a much better picture of policy in 25. At least we hope we will, 2 days after the US election.
And the Fed has to respond to it. That's the tricky thing. Now they can kind of punt in a much more obvious way. We're going to just do what we do. It'll be different when we actually have a little bit more certainty on November 7th.
Subhadra Japra, SocGen. Subhadra, good to see you.
Good to see you.
Some original views on what's going to happen with that cash on the sidelines. Always hear about that cash on the sidelines.
Is it really on the sidelines, I think? This from Bespoke, I just want to bring this statistic to you because I think it's pretty fascinating. Today is set to be the biggest gap higher for the S&P 500 ETF after a scheduled Fed day since October 30th, 2008, after Bernanke cut by 50 basis points in the midst of a financial crisis. That gives you a sense of the scope of just absolute celebration on Wall Street today.
Are you trying to make us nervous going into the opening bell?
No, I just think that's an interesting data point. You can draw your own conclusions. I'm watching gold.
I've drawn mine. Equities right now on the S&P 500 are by 1.6%. Really? Gold? Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. United Airlines says that they have started to track Taylor Swift's Eras Tour to make sure that they have enough seats. The chief commercial officer, Andrew Nocella, spoke at a conference yesterday saying our demand booms wherever she goes. He said that they've seen a 25% increase in demand, or maybe even more, on flights during her weekend concerts. The International Brotherhood of Teamsters will not endorse neither Kamala Harris nor Donald Trump. Teamsters President Sean O'Brien saying in a statement, we saw commitments from both Trump and Harris not to interfere in critical union campaigns or core Teamsters industries and to honor our members' right to strike, but we're unable to secure those pledges. The New York Yankees are gearing up for the playoffs. The team clinched their postseason spot last night, beating the Seattle Mariners 2-1 in 10 innings. The Yankees are recovering from a rough 2023 season. It was their worst since 1992. They now, though, hold the American League's best record at 89-60.
A lot of opportunity with those businesses.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Stocks doing nicely here, up by 1.5% on the S&P 500. Yields higher, up 5 basis points on a 10-year, 375.85, as jobless claims come in better than expected, the right kind of downside surprise. As we count you down to the opening bell, your trading diary, your week ahead looks like this. President Biden speaking on the economy at 1:15 Eastern. FedEx earnings coming after the closing bell tomorrow. We'll get a BOJ rate decision, and Fed speak returns with Harker on Monday. S&P Global PMI data, plus we'll hear from Bostic, Goolsbee and Kashkari. We'll get consumer confidence numbers on Tuesday, and rounding out the week, Thursday, GDP plus another round of jobless claims. Mike McKee, final word on the data and the decision of yesterday, please.
I think at this point we've definitely crossed into a new paradigm, new regime, whatever you want to call it. We're going to think differently about the data coming in, and we're going to trade differently on the data coming in. Not only that, but we start to price in the political aspects of it. And even before we know who's going to be the president, we're going to be worried about whether or not they shut down the government. And then going into the year, we've got the debt ceiling coming back again. So there are a lot of things that will come in. Now that the Fed has moved, the markets will expect it to keep moving, and they've got a timetable, whether they stick to it or not. They can start to think about other things.
What I'm hearing from Mike there is, thank God it's over, and we can stop talking about it now, which is essentially what we're hearing from other people, too.
You can stop asking me 50 or 25.
Well, no, we can do that again.
Give it a month. We'll be doing that November 7th. Don't worry about that.
100%.
Mike McKee, thank you. This has been exhausting, hasn't it?
Well, I think for everybody.
Just the last few days, the last few weeks of this.
This is basically the theme that I hear from all of the notes is, okay, we're done. It was great, whatever. It was the biggest kind of yawn after so much buildup, but it wasn't. And I think that that's what you're seeing in equities, and that's what I'm watching most closely.
You're not done. You've got a big interview later, right?
Yeah, I'm going to be interviewing the JetBlue CEO at a time where there's a real question, exactly to your point, about the Spirit JetBlue deal that didn't go through, but also consumers. Are they flying? Where are they flying? How are they flying?
We'll find out. 12:15 Eastern Time here in New York. Don't miss that. Coming up tomorrow, your lineup: Chris Verona of Strategas, Paul Donovan of UBS, Matt Hornback of Morgan Stanley, and Veronica Clark of Citi from New York City this morning. Good morning. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest, and whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe.
And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, we're looking at some big moves post-Fed cut. 30 minutes until the start of cash trading. I'm Matt Miller.
And I'm Shonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, the Fed's power move ripples through markets as bets for more cuts ramp up. Next up, it's the Bank of Japan's turn. And with less than 7 weeks until the election, the Fed has reframed the debate about the economy. We've got the latest from the campaign trail, plus global Wall Street reacts. We'll hear from BlackRock's Jean Boivin, RBC's Amy Wu Silverman, and renowned investor Steve Eisman. First off, let's take a look at where the market is trading, and it may blow your mind if you're just waking up, because we have futures gaining 1.5% on the S&P, more than 2% on the NASDAQ. This after we retreated during yesterday's session. So it looks like investors have had a chance to digest this move and thought, no, they got a lot more cutting to come, Shonali. Is it possible that we get another 50 basis point move in November?
Well, the bond market might not be saying so. 6 basis points on the 10-year. We'll talk about that in a little bit. Some stocks to watch before the market opens. Keeping an eye on NVIDIA today, the world's third largest company, jumps in pre-market trading, and by a significant amount, 3.2% nearly. Mobileye jumping 7.4%. Intel says it does not have plans to divest its 88% stake in the autonomous driving company. And Darden Restaurants reported sales that missed estimates but showed improvements after July. Consumers are spending. You see Darden up 8% pre-market. Investors are also applauding a partnership with Uber to deliver from brands like Olive Garden and Longhorn Steakhouse unlimited breadsticks at home, Matt.
Oh, that sounds lovely. At the end of an era for, I guess, a 4-year era for rates, the Fed pivots, but no commitments for further cuts this year.
A broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
All right, so he, seemed to be downplaying what's to come, as well as the dot plot kind of downplayed that. We'll touch on that when we get to Mike McKee. But I noticed that Michael Feroli over at JP Morgan, who was the only big bank Fed forecaster who got it right, said we could have another 50 basis point move in November if the labor market is weak enough.
And what's interesting is it so far is not showing that. We'll talk more about that in a minute. You can see how much the bond market was a little overbought here, because you're seeing the 2-year and 10-year rising, and that steepening just taking off, a 12 basis point differential at this point in time. You're seeing the 10-year yield move almost 6 basis points higher this morning after a 50 basis point cut. So that tells you a little bit about how
and it's all there, because if you look over the last 3 days, the 10-year is actually up about 12 basis points. So I guess that's where the steepening is coming from. It's more of a bear steepening. Joining us now is Michael McKee, Bloomberg's chief international economics and policy correspondent. Mike, we're back to watching the data. As Shonali points out, the labor market data that we got today, we get, claims, didn't show anything interesting, but Michael Feroli says if we get, 100,000 or less in the September number, the Fed could be off to the races again.
Yeah, these numbers don't tell you anything about what we're going to get when we get to the September jobs numbers, but this was the survey week for the jobs numbers, and we saw the jobless claims fall to 219,000 from 231,000. We just keep going down. Now, that may be somewhat affected by seasonals, but it's still a very low number. We're stuck in a range there. The other number out today, though, that may be influencing a little bit that 10-year yield, the Philadelphia Fed, comes in at 1.7, a big jump from -7, but look at what prices paid did, rose 10 points, and just about every sector in the Philadelphia index reported higher input prices. So something to keep an eye on is inflation down the road. Now, the Fed is going to try to follow its plans for 25 basis point cuts at the next two meetings, but they are aggressively starting to cut now. By the end of next year, the new dot plot says 3.4% will be the final, and you can see how we've shifted down there from where we were.
As the terminal rate?
And the terminal rate moved up to 2.9. So that's a question of whether they think that is actually neutral. And I think what you'll see is that these numbers, these dots float around a lot over the next year because we have so much going on out there that could really change things. We'll be watching borrowing costs, of course, to see what happens. And we've already seen prime rates come down. Mortgage rates and auto rates came down into the meeting as people anticipated what the Fed was going to do. So the real question for consumers is those really tall lines there, those are the credit card average rates. And you can see they're much higher and they are stickier. But let's see if they come down with any kind of dispatch that might lead consumers to spend more. And then the Fed has to worry about a little bit inflation.
You got to pay off those statements every month. Chanel, you can't let it slide.
Oh, I've been letting it slide for years. It's obviously not. There's also going to be lower savings rates pretty soon, too, I'm sure, too. So that should move some money. Michael McKee, we thank you so very much. We are joined by Jean Boivin, head of the BlackRock Investment Institute. And you think about that first cut, that large cut, and the expectations moving forward, the uncertainty ahead. How do you think the calculus has changed for investors after yesterday?
Well, I think the market reaction, and as you see since yesterday, is trying to figure that out as we speak. I think, and I think it reflects, in our view, some mixed messages that have been coming through yesterday. We would love to see to think that there's an all clear now and we have clarity on what's coming next, but I think the reality is very different. Mixed messages because on the one hand we had a big 50 basis points cut. But on the other, we had get a characterization that the economy is solid, the risks are balanced, and the Fed they think are not beyond the curve. So that this one of these things that doesn't seem to be aligning here. Mixed messaging because we're talking about recalibration, which has a meaning that it's not autopilot and so on. At the same time, they're signaling very aggressive cuts from here, as we were just discussing. So I think the mixed messages mean that, like, as we go, we're gonna start looking back at this meeting and maybe interpret what was said differently. So I don't think we're done here.
Well, it's interesting. You see the jobless claims data coming in this morning and showing some promising signs in the labor market. You also see it in earnings, at least for this morning. Interesting to hear Darden Restaurants saying that after July, traffic really started to improve. Didn't you also think about the idea here that a 50 basis point cut by the Fed would also start to impact savings rates that you might get at a bank, particularly ones that have been offering such high rates to consumers to begin with? How much money can move and where does it go to?
Yeah, so I think